For years, the crypto market told itself a reassuring story that this time was different, that the industry had matured, learned from early failures, and built institutions that could be trusted. FTX stood at the center of that story. It was not presented as an experiment or a risky frontier platform, but as a professional exchange designed to bridge crypto and traditional finance. Its branding emphasized stability. Its leadership spoke the language of risk management, compliance, and responsibility. To many users, FTX felt less like a startup and more like infrastructure. What made FTX feel safe was not just its size, but its speed. It grew faster than any major financial institution in modern history, onboarding millions of users, handling billions in daily volume, and attracting capital from some of the most established names in global finance. Venture firms, hedge funds, pension-linked investors, and media companies all treated FTX as a validated platform. In a market defined by volatility, FTX appeared to offer certainty. That sense of certainty mattered. Crypto markets operate without deposit insurance, without lender of last resort guarantees, and without the stabilizing friction that exists in traditional finance. In that environment, trust becomes the substitute for structure. Users trust that their assets are available. Counterparties trust that balances are real. Investors trust that financial statements reflect economic reality. FTX became the focal point where all of those assumptions converge. The collapse did not unfold slowly. There was no long recession, no gradual erosion of confidence. In a matter of days, one of the most trusted institutions in crypto went from solvent to bankrupt. Withdrawals froze. Markets reeled, and a company once valued at tens of billions of dollars was exposed as unable to meet basic customer obligations. The speed was not incidental. It was the defining feature. Traditional financial failures often take months or years to surface because capital moves slowly and disclosures lag reality. Crypto operates on a different timeline. Assets settle instantly. Information travels globally in seconds. When trust weakens, capital does not wait. The same efficiency that allows crypto markets to function without intermediaries also removes the buffers that hide structural weaknesses. FTX did not fail because blockchains broke or cryptography failed. Trades cleared, transactions finalized. The technology did exactly what it was designed to do. What failed was the assumption that trust alone could replace formal controls, segregation of assets, and transparent balance sheets. FTX was not a story about reckless users chasing yield. It was a story about an institution that asked the market to trust its internal discipline and a market that agreed without demanding proof. This is why the FTX collapse matters beyond one company or one cycle. It revealed how quickly confidence-based systems can unravel when incentives are misaligned and oversight is informal. It showed that in markets built for speed, structural weaknesses are not smoothed over by time. They are exposed by it. FTX positioned itself as a solution to the problems that had defined earlier crypto exchanges. Where others emphasized ideology or rapid experimentation, FTX emphasized professionalism. It promised deep liquidity, low fees, and sophisticated trading tools designed for institutional and advanced retail participants. Derivatives, futures, and complex instruments were presented not as risks, but as evidence of maturity. The message was clear. This was a platform built for serious markets. Central to that promise was reliability. FTX marketed itself as an exchange that could handle extreme volatility without breaking. During periods of market stress, when other platforms experienced outages or halted trading, FTX highlighted its uptime and execution speed. This consistency reinforced the idea that FTX was not merely another participant in the crypto ecosystem, but a stabilizing force within it. FTX also promised alignment with regulation, even while operating largely outside traditional regulatory frameworks. Its leadership publicly supported oversight, engaged with policymakers, and framed the company as a responsible actor, willing to help shape future rules. This posture reassured investors and users who were uneasy about crypto's legal gray areas. FTX did not present itself as anti-regulation. It presented itself as regulation-ready. Another key promise was capital efficiency. FTX claimed to manage risk dynamically, using advanced margin systems and real-time liquidation engines to prevent cascading failures. Losses, users were told, would be contained, Exposure would be monitored continuously. The exchange would remain solvent even in extreme scenarios. These assurances mattered because crypto markets lack external safety nets. The exchange itself must function as the risk manager of last resort. FTX also blurred the line between exchange and ecosystem. It invested in startups, sponsored major events, acquired competitors, and embedded itself deeply into the industry's infrastructure. This created the impression that FTX's success was inseparable from the health of crypto itself. To doubt FTX was, in some sense, to doubt the market's progress. What the market accepted, often without scrutiny, was that these promises rested primarily on internal controls rather than externally enforced ones. Users did not see audited, transparent balance sheets that clearly separated customer assets from company capital. They relied instead on reputation, endorsements, and the perceived sophistication of the operation. In traditional finance, such trust is supplemented by disclosure requirements, capital rules, and independent verification. At FTX, trust functioned as the primary guarantee. By presenting itself as safe and institutionally sound, FTX encouraged users to treat it as infrastructure rather than a counterparty. Assets stayed on the platform, risk assumptions loosened, and scrutiny faded around how those assurances were actually maintained. Behind the image of a neutral exchange was a trading firm whose role the market misunderstood. Alameda Research was described as an independent liquidity provider, a common feature in exchanges. What made it different was not its function, but how closely it was tied to FTX itself. FTX and Alameda shared origins, leadership, and operational proximity. This created an incentive structure that was fundamentally asymmetric. Alameda was not simply another customer subject to the same constraints as everyone else. It was deeply embedded in the ecosystem that FTX controlled. Over time, this proximity turned into dependency. Alameda relied on FTX as its primary source of liquidity, execution, and capital flexibility. When trades went well, the relationship appeared benign. When trades went poorly, the structure mattered. Losses at Alameda did not remain isolated within the firm. Instead, they created pressure that flowed inward toward the exchange that facilitated its activity. What the market did not see was how closely linked these entities had become. Instead of operating as separate risk-bearing firms, they functioned as interconnected balance sheets. Alameda's trading depended on capital access controlled by FTX, weakening the constraints that normally force losses to be absorbed or activity to stop. This dependency mattered because exchanges occupy a position of structural trust. Users deposit assets assuming the exchange is neutral and insulated from proprietary risk. Once an exchange becomes financially entangled with a trading firm, that neutrality erodes and the exchange begins to absorb risks it was never meant to carry. As market conditions deteriorated, Alameda's positions became increasingly difficult to unwind. Liquidity thinned, losses mounted. Rather than absorbing those losses internally, the structure allowed them to be deferred. Risk was not eliminated, it was postponed. And postponement, in fast-moving markets, compounds vulnerability. The critical failure was not secrecy alone, but misalignment. FTX's users bore risk they did not agree to bear. Alameda's survival depended on access to resources that were implicitly trusted to be segregated. The exchange's role shifted from facilitator to backstop, without the capital buffers or disclosures that such a role requires. When trust-based systems encounter stress, hidden dependencies surface abruptly. Alameda was not a side story to FTX's collapse. It was the mechanism through which internal losses became an existential threat to the exchange itself. If this video helped you see Bitcoin's history more clearly, like this video. It really helps the channel. Subscribe for more deep, simple documentaries on money, technology, and the stories that shape the digital world.